This content reflects my own personal opinions and is not financial advice. With that said, let's kick off today's episode. Markets are bleeding from Wall Street to crypto wallets. Some say it's all about liquidity. With the Fed's quantitative tightening set to end on December 1st, will that finally stop the bloodbath, or is the worst still ahead? So I'm going to run through with you just a few concepts which will help me explain why the quantitative tightening is such an important driver in terms of impacting the market dynamics and subsequently the major causes for this broad mass market bloodbath, whether it's financial and crypto markets. So the central balance sheets, just to be very clear, they are mostly assets where they actually hold government bonds such as treasuries, gilts, mortgage-backed securities and even foreign reserves. And also it holds some liabilities, so the bank reserves, when they make certain deposits on the commercial banks in those accounts that are hosted in their central bank's balance sheets, well, they make those liability payments through there and currency in circulation. So the main purpose of a central bank balance sheet, whether it's the Fed, the ECB, the Bank of England, the Bank of Japan, they all function the same sort of way. Now the purpose is just to reflect how much liquidity the central bank has actually injected into the financial system. It doesn't cover the nation's wealth. That's perhaps some of the confusion that maybe some people automatically assume. That is not the case. It's the central bank's own financial position, not the government's fiscal budget. So the two is separate and it's different. Now, what is the relationship between the central bank and its national treasury department? That is quite an important factor to actually understand what we're talking about here. The Treasury Department actually issues the bonds in order to finance the government spending. So that is the fiscal policy that they are responsible for. Whereas the central bank, mind you, they buy and sell those government issued bonds in order to manage liquidity and interest rates through those famous monthly monetary policy committee meetings, right? So that is the separation of the roles between the Treasury Department on one hand and its national central bank on the other. The Treasury simply raises funds for government financing, whereas the central bank controls the money supply, inflation, and the financial stability of the economy at large. Now, just to complete this picture between what is quantitative easing versus quantitative tightening, because the two is very different. So quantitative easing is where a central bank buys a government issued bonds and credits the banks with reserves. And that's how it's manifested on the central bank balance sheet. It just simply expands. And through that expansion, it means increased liquidity is injected into the money supply. Thereby, the liquidity goes up, ultimately lowers the cost of borrowing, and where we see the tendency for risk assets rally. Because the cost of borrowing goes down, well, that is a perfect condition for investors, whether it's institutions, corporations, even retail investors, can actually borrow at a cheaper rate. And that's why we see the trend for the risk assets to rally. Whereas in contrary, whenever an economy or its central bank finds itself in a quantitative tightening mode, well, it's the opposite. Well, the central bank will just simply release or sell off those government issued bonds that they've bought originally, or they just simply let the bond to mature. And that's how the balance sheets actually shrinks in size. And the repercussion of that is the opposite to quantitative easing, QE, where the liquidity for the economy goes down, thereby increasing the cost of borrowing and the tendency for risk assets to sell off. Because in absence of any liquidity, well, people will have to just simply sell off what they have, mostly risk-on assets, which is the case with stocks and equities, but also crypto and Bitcoin. There's been $1 trillion worth of liquidation. And that's where we see ourselves at the moment, particularly in the US capital market and also in other leading economies. And why do central banks make these sort of notorious actions, you might be asking? Well, in the case of QE, since it concerns with expanding the money supply and thereby the economy, it's more of a stimulus. So it's a way to manage emergency situations or financial crises, right? We're all familiar with the GFC of 2008 and likewise with the 2020 pandemic. That is an example of major emergency situations where the central banks have to intervene and inject liquidity into its economy. right? And they do this, as I said before, by buying government issued bonds, crediting the banks with its reserves, and that's how it manages the injection of extra cash and liquidity into the supply. So the goal there is to support growth, lowering the cost of borrowing, stabilizing the markets in times of crisis, as I mentioned earlier on, and also to help finance government deficits indirectly. In the contrary, with QT, quantitative tightening, it's used fundamentally to control inflation. So whenever inflation is really high, and that's where central banks perform QT actioning, right, which has been the case with the Fed from 2022, in the height of the pandemic, until December 1st of this year, is where the expectation for the Fed to end is QT and entering in QE. So the goal in the case of QT is to drain liquidity, cool demand, and restoring monetary discipline by way of reducing inflation. So the key takeaway here is Treasury issues bonds to fund spending, central banks buy and sell those bonds to control liquidity, QE injects liquidity, which in itself boosts markets, whereas QT is the opposite, drains liquidity. It suppresses inflation, but pressures risk assets. So that is really, I think, one of the key causes as to why we are seeing this massive broad market sell-offs in the financial markets and the crypto markets at large. So the last table here gives you the actual statuses of the central bank's balance sheets as of this month, November 2025. So in the case of the Fed, they have the largest balance sheet, being the largest economy in the world. It has over $6.5 trillion as of November 5th, 2025. And the current mode is QT, but as I said earlier on, the expectation is to end it. And the announcement will most likely be made on December 1st, where they're going to halt on QT and then revert back to QE. So they can be buying bonds, injecting capital and liquidity that is desperately needed into the economy. And hopefully by doing that, there'll be a propensity for investors to borrow capital at a cheaper rate and move those investments and capital allocations into risk on assets, particularly stocks and equities and crypto and all the rest of it. The European Central Bank, the ECB, has almost 6.5 trillion euros, 4.3 of which is just currency. So they're currently in QT, quantitative normalization mode at the moment, and there isn't an expectation for the ECB to end QE. So they'll still continuing on with QT until a future date has been released where they're going to revert back to QE at some point. And the same can be said for the other two major economy central banks' balance sheets, the Bank of England and the Bank of Japan. So hopefully this episode has given you a brief explanation as to, how the central bank balance sheet work. I talked about the relationship between them and its national treasury departments in terms of how the actual issuance of bonds and who purchases them fundamentally, which are the central banks, obviously, and how in the case of the US, where they're in extreme quantitative tightening mode, and in fact the $6.5 trillion is the lowest balance sheet in US history. So it's no surprise at all that the market has been in a state of exhaustion, right? They are desperately needed to have liquidity because the US Fed have actually sold off or just simply matured their previously purchased US government bonds in its balance sheet, which has drained the market of liquidity. But like I said, the expectation for the market is December 1st will be the end date of the quantitative tightening by the US Fed, and they're going to revert back to QE, which hopefully will give a sign of relief and bring back desperately needed liquidity into financial markets. That's all I have for you for today. If you value clarity on Bitcoin, blockchain technology, and real-world assets tokenization, stay alert. Subscribe and enable all notifications to stay ahead of the curve. Share this episode with those who need to understand what's coming, friends, family, and colleagues. This channel aims to deliver insight, no noise, and no hype. Subscribe now.